Welcome to the halftime report on this Friday. Front and center this hour, the stronger than expected jobs report and what it might mean for stocks now going forward. Joining me for the hour, Stephanie Link, Jason Snipe, Jim Leventhal, Rob Sechin. We will check the markets. We are green today after that report did crush expectations. Yields are up substantially, I guess, after that data too. And I think you could make the case they're up for the right reason. They still may be putting a little bit of a cap on activity today. I think, Steph, the bottom line here is that soft landing story or no landing story is intact. Good economy greater than bigger rate cuts. I think that's how we're generally thinking about stuff, as we're only about 0.75% away from new highs on the S&P 500.
What a good week we had in the economy in terms of the economic data. Initial claims were much better than expected in terms of the 4-week moving average. You're running about 230,000. Initial jobless claims. ISM services way better than expected, almost near 60. That's huge because services is 75% of consumption. If you listen to the Redfin CEO this week on CNBC, he talked about new home growth being 10% last month alone, and that's as rates have come down. And of course, non-farm payroll numbers, yes, it was a good number, and the revisions were good, and wages were good. I root for higher wages. I know it's inflationary. I know we're going to talk about maybe inflation is going to be a little bit hotter than expected because of it. CPI, let's watch that next week because that's going to be really important. But I don't think inflation is out of control by any means. I root for higher wages. I root for the consumer. It's 70% of consumption. All of this, you add it up, it's really good for profits. And stocks follow profits on the way up and on the way down, and they are headed higher.
That's why the Flow Show, Rob, at Bank of America says the bulls are in control. Tom Lee, after the jobs report today, says good news, good news. Today's shows good news. U.S. economy remains strong, thus bull market is intact. Savita Subramanian this morning, talking about the word of the day. Listen.
I hate to say this word because I know that equity strategists are always accused of being Pollyanna-ish, and I've been bearish before, but I feel like this is Goldilocks. This might be Goldilocks.
Okay. Is she right? Is this the perfect environment? Is it just right for this bull market to carry on?
I would say it's Goldilocks on steroids, Judge. The only bad thing that you can say about this market is things cannot stay this good. The things that are working on our favor are inflation is coming in, the jobs market's holding strong, the Fed is easing, other global central banks are easing. That's definitely a good environment in the short term and may surprise us through this typical October seasonal weakness. You do have some things that are out there in valuation, sentiment, and positioning that you have to be aware of. But the economic situation is supportive in the near term. And while those things kindle and they could be something that goes wrong, there's just not the spark there that ignites that. I think we're in what could be a surprising environment. Tom Lee thought there was going to be maybe some agita in October, which led to a post-election rally. And I think, this might have tabled that for a bit because of this, super Goldilocks world we live in.
Yeah. Jason Snipe, is that how you see it? Whether it's Goldilocks on steroids or whatever it is, it's still a constructive and very much so environment for this rally.
Yeah, I think it's absolutely constructive. I don't know per se if I think it's actually Goldilocks, however, because to Steph's point, I think there are some pieces that potentially we might see some upside surprises on inflation. Crude is up 10% over the last week. Obviously, that's in rest in what's going on in the Middle East. Jobs, inflation, wage inflation obviously could participate here. But what I will say is good news is good news. We got good news on ADP. We got good news on JOLTS. Obviously, non-farm was really positive today. And to Steph's point, upward revisions was also positive. So I think those will carry through. But I think the other point I would make is I think we are priced for perfection. Right, so I think there are some hurdles going forward, but all in all is well.
This is all, Jim, why Brian Belsky, for example, in our orbit, raised his price target a couple of weeks ago to the highest on the street, 6,100. It's why Goldman's Scott Rubner said this week 6K might be too low, his target. It's why Ed Yardeni is talking about no landing being in the cards on the expectations that after getting some pretty good data already this week and then buoyed by the jobs report, that you've got a good economy, and even as the Fed chairman talked down the size of future cuts, that's just fine.
I think those targets are in sight, frankly. And Jason, you just made a very good point about things being priced to perfection. At 21 times forward earnings, you could maybe lay a claim that they're, ahead of themselves. But here's the thing. I really think we're going to crescendo into year end. That's what usually happens when you have a year like this. 9 months into the year, you're up 20%. What happens in the final 3 months is a bunch of forces at once. First off, any money manager who was bearish at any point this year is behind the index if they've held cash. So now they've just got to throw money at the market on any dip and get involved. That's number one. Number two, as you get to the end of the year, and so many stocks are in a positive return category, there's going to be an absence of selling because people don't want to take tax gains, capital gains, this late in the year. I realize not everybody's a taxable investor, but that's the case. On top of that, the election, which some might say is a risk, but I certainly don't know how it's going to turn out. What I do know is this is the point in the election cycle where the current administration tries to get as much liquidity into the economy, as much cash into consumers' hands as possible. And that's what they're doing, whether it's student loans, whether it's PPP claims, they're getting as much cash as they can into the system. Last thing on this, and by the way, this is all technical. It has nothing to do with valuation. Your point is very well made. The Treasury is going to have to start spending down its Treasury General account at the Federal Reserve. I'm not going to go into the arcane details of it, but that adds liquidity. They're going to have to spend that down as we go through the debt ceiling rigmarole, which, yes, we're going to have to do that again. All of these forces are likely to propel the markets higher despite what risks there are there.
Yeah. I mean, I guess one thing seems pretty clear at this point, that barring a surprise, this data that we've gotten this week, culminating with today, cements 25 at the next meeting. Steve Leisman, our senior economics reporter, joins us now. That's certainly how we should take this, correct? I mean, it pretty much validates everything that the Fed chair himself has been saying, right?
Can I give you a 3% correction, Scott?
Go ahead.
So it turns out that one of the results of this morning's meeting, of this morning's number, was to introduce a very slight possibility of no cut. And I just want to offer that because that has not been on the table as a potential risk or a potential outcome here. And it is a very slight probability. But if you look at the way the November 2024 contract is trading, it's 97% for a 25 cut. What's important, by the way, about that chart you're looking at right there is you'll notice nothing to the left. There is no 50 basis point probability. Now let's go on and look at the December probabilities, and what's happened is the probability of a 25 is quite a bit higher. Again, where did that come from? It came from the probability of a 50. I want to do one more thing, Scott, which is to show you what happened to the September 25 contract. What that tells you and what that shows you is about 50 basis points of cut if you go from the 287 to the 345, 341 area right now has been baked out of expected rate cuts. So what's happened now is the market is saying, okay, I'm replacing Fed rate cuts with better economic growth, and it's kind of to the positive side. That's the way I look at the trade today. I think that this number might well be overstated. It was a low response rate. We could have revisions. They've mostly been to the downside. Today they were to the upside. But I think what it does tell you is the job market is okay. This fear of weakness that we had over the past several months is no longer really an abiding concern.
You look at these numbers today and you take them in the totality of what we've gotten this week, and some are once again raising the issue, Steve, and I think speaks to the very point you're making here about that 3%, that the Fed should get rid of its forward guidance because it is inaccurate in guiding them on what would be legitimately right to do here in this situation. I raise this because Stanley Druckenmiller has made some comments to another outlet via email in which he says, quote, I hope the Fed is not trapped by forward guidance the way they were in 2021. GDP above trend, corporate profits strong, equities all-time high, credit very tight, gold new high. Where's the restriction? It speaks to the idea that some suggest, well, the Fed is too restrictive now, which is in and of itself a reason to continue to cut interest rates, where he says get rid of forward guidance because we're not as restrictive as one would like to believe that we are?
I would not agree with all of that. I'd agree with some of that. I think that the Fed is told us that they're recalibrating the funds rate, not necessarily for the current level of growth, but to the current level of inflation, which has come down quite markedly. And the Fed set the funds rate to a level that was trying to combat a much, much higher level of inflation. That inflation level has come down, and that is what justifies the Fed's rate cuts. Whether or not it justifies all of the rate cuts the market has priced in, well, A, the market's backed off of how much it's priced in, and B, the Fed has made a forecast but not necessarily provided forward guidance of how much they will be cutting. The idea that another cut is in the cards, I think that's probably right. Another 25 for this year, or maybe another 50 for this year, probably right. But what I've done, Scott, is every Fed officials I've talked to, I've asked, what's the easy part? What's the part where you can cut and still think you're restrictive and not necessarily near the neutral rate? And they've told me somewhere between 100 and 150. I think that's reasonable to bake in as part of the recalibration process, not a process by which they're worried about the idea that you're going to be getting down and close to neutral. And I also think, Scott, that just because we put a lot of people to work doesn't mean it's inflationary. I think we need to get off of that train a little bit. There were people to put to work. The participation rate did not change. We didn't lower it. We put unemployed people to work. And I'd like to go back to what I told y'all the last time we had this rise in the unemployment rate, which is that there is this pattern. People have entered the workforce, they spent a month unemployed, and the next month this economy has put them back to work. So we're not necessarily a disaster when it comes to this economy. It's a pretty good economy. And just because we're putting people to work, just because we're growing at or above potential, doesn't mean it's inflationary.
I should also, I think, suggest that one's opinions can sometimes be influenced by the company in which they keep. I bring that up because Kevin Warsh works for, I believe he still does, for the Druckenmiller family office, and he has made the same case that Druckenmiller seems to be making today in the past. And if memory serves me correctly, Warsh would be certainly on the more hawkish side of the legislature of the Fed. Do I have that at least somewhat correct, you think?
Yeah, but I would only take that so far. Look, Stan is brilliant. He makes a lot of money trading, and I would, oppose his point of view at my peril, or maybe at my poverty peril. Kevin is a really smart guy. He served on the Federal Reserve, and he was there during the crisis. So I listened to those people. I talked to them, and I'm glad to be able to talk to them. I just don't think right now that is the argument to have at this level. I think if we were down near 4% or 4.25%, we could have that argument. Should the Fed go another quarter, go another half? But in this modality, I would say, of essentially recalibrating policy to be more in line with where we are. And by the way, the risks, just because you had one good month doesn't mean that the risk of a weakening job market goes away. There are still lags to monetary policy that are worth taking into account. I think it's a good argument to have. I think it's a good thing to worry about. I think that's what we do. That's why we listen to everybody, Scott. That's why we talk to everybody. I just don't think that's the prevailing concern right now. I think it's Friday. I think it's going to be nice weather this weekend in the Northeast. I think you can take this number, enjoy it, and there'll be plenty of time to worry about that stuff on Monday.
Yeah, no, you have good points, of course. Your insight is so valuable as we're trying to sort of digest and dissect all this. Steve, thanks.
Pleasure.
I appreciate you. And by the way, Powell said himself he's not on, the Fed's not on some preset course. Nothing is set it and forget it, despite what some, I think would otherwise believe. A good question when we talk about positioning in this market right now, Steph, is, as the Wall Street Journal asks today, and I think it's really relevant to what we're trying to figure out, if a soft landing is in fact in the cards, why aren't small caps rallying? I heard a lot about, well, they will rally when the Fed starts cutting, and once it becomes more clear that you can actually land the plane softly, if you even need to land it. And yet these stocks really aren't working all that much.
Well,
Why?
it's kind of interesting because small caps and value trade together. It's the same factor, and actually value has started to outperform growth. So I would think that small caps will play catch up, especially if the Fed does lower rates. Let me just go back to the job number. While this number was really good, and everyone will say that it's an outlier, the last 3 months on average are up 185,000 jobs. So it's very healthy. Atlanta Fed tracker is running at 2.5%. I suspect on Tuesday when it comes out, again, you'll be maybe even north of 3%.
Right.
Point being that you have a lot of growth. We have to watch the inflation piece, though, Scott, and I watch it on the wage side, but I also watch it from China and the stimulus that we got. I know, but
I respect that, but I want to move on.
I
don't want to
understand.
talk about that. I want to talk about positioning in the market.
Well, I understand that, but I'm just trying to tell you the growth is out there, and if inflation stays low and the Fed continues to lower rates, value has started to outperform. Small caps will play catch up. It's really as simple as that. So I don't own any small caps, but I do own a lot of value. Where do I want to be? I want to be in cyclicals. I have been all year. First half of the year it was wrong. It's actually starting to be right. Where do I want to be on themes? I want to be in housing. I want to be in cybersecurity. I also want to be on the power and grid, even though it's pretty crowded now. I want to be in aviation. There's plenty of places that I want to be in addition to tech. But I think that you are going to continue to see this broadening out as the growth in the economy continues to be strong. That's why I mentioned those other numbers.
Well, I mean, industrials, record intraday high again today. Financials. These last quarter. By now, everybody knows that utilities were up 19. It was the best quarter since 2003. Real estate, industrials, financials, and materials, Jason, were the ones that were leading. But it is peculiar, to say the least, that the area that some thought was going to get maybe the largest boost by all this, I just go back and reference Tom Lee suggesting you were going to get a 50% rise in small caps. Like this was, I'm going to get you in a second, Jimmy, because I know you're there too. That this was all you needed. And yet we're like, fits and starts. Like the engine's like, needs a tune-up or something.
Right, and true. And I don't think it's absolutely that simple. As soon as you start easing or interest rates start to come down, you'll start to see the rise in small caps. Typically, you start to see small caps really start to outperform a year after the first cut. Right, so I think it potentially is a little bit early to see that move. I can see the story, and it's a mixed bag of small cap value, there's small cap growth, there's obviously the unprofitable stuff. But I think small cap value a year out, that's when we'll start to see some of the return. But I don't think it's that simple of a story. As soon as rates come down, they start to run.
Jim, you've made a very big bet. You've made it publicly on our program that's the area that you were banking on. What's going on?
And I continue to be in small caps, and I continue to think it's going to work. But the question has to be asked, and I think there's a simple answer. Earnings have been punk for the small cap sector. I mean, that's just a fact. And if you look at earnings estimates for this year and next year, they're down 10% from where we started the year. So I think what the market is saying is prove it to me. Prove it to me in earnings starting to be revised upwards, earnings starting to come in better than expected. And I think that is likely based on two things. One big one, which is we're not going into recession, okay? And some of these earnings estimates still have baked into them recessionary outcomes that are highly unlikely. So I think you're going to see
not really.
The top line.
They don't really. I mean, if you're looking at earnings growth, hold on, I'm going to come back to you. Earnings growth expectations are not like, they don't even whisper recession. They have come down a little bit, but so slightly they're not in any way inflationary. Going from 8.5% earnings growth on July 1st to today 5% for the current quarter, that's not recessionary, excuse me, that's the word I meant, recessionary. 14.8% for the fourth quarter to 12.5% for the first quarter of next year, 15.4 to 14.1. Those are still good, and those are still healthy, and those are still strong earnings growth numbers.
Scott, by the way, thank you for using the adjective good. Not great, but good. Because I want to point something out. The small cap sector, the IWM, is up 10% year to date. Now, I know we're looking at the S&P 500 and saying compared to the S&P 500, that stinks. But it's actually good on an absolute basis. It's actually good on a one-year basis that we're up 28%. To the point I'm driving at, and I do want to make this point, okay? Yes, we've just started cutting. If you go back to, pick a date, I'll take July 31st. I'm looking at FactSet. I'm looking at the S&P 600, which is what I'm invested in. The earnings for this year on July 31st were 82.77. Now they're they're 80.59. Meaning, even though we've had our first rate cut, the estimates have still gone down over the last 2 months. My point is, you only get earnings revisions down in the last 2 months, even as the Fed is cutting, on the basis that people think a more dire outcome is coming for small caps than is likely to occur when you think about interest rates going down and you think about the top line on small caps being enhanced by a growing economy, to Steph, your point of a 2.5% GDP.
Today is also, Rob, a good reminder, as you know, you have the culmination of a week in which you have good data, and you've obviously had some issues to deal with this week, including the Middle East, which is not going away anytime soon. There's just no doubt about that. And yet NASDAQ is leading today. Take the Russell out of it, which is obviously beating the majors in percentage performance thus far, but you're up 2/3 of 1%. You got earnings a few weeks away, and these stocks, after being a little sleepy for the majority of the last quarter, have woken up a bit over the last month. Alphabet's up 6, Amazon's up 5, Nvidia's up 16, Meta is a record intraday high today, up 14. Some would suggest the underperformance leading into the most recent gains that I've just mentioned have lowered the bar for mega cap stocks as earnings season comes around. What do you think about these stocks here?
So listen, they're still very expensive. They're 28 times forward PE, down from 32 in July. It's still very crowded. Does not make a big tech recovery back to leadership a given. However, the tech's earnings trajectory is still really good. It's expected to report the highest 24 year-on-year earnings growth of all sectors at just over 15. And 25 EPS estimates are 21. That's the second highest behind healthcare. I mean, it's tough for me to see an environment where businesses that are this good, this strong, and have this much interest really trade down. So I think it might be a pause that refreshes, and we're still in a lot of these names, as you know.
You know, Steph, I wanted to ask you about Amazon, which has been down 7 days in a row. Now, it looks like it's going to break that streak today. And you've had some people put out some tactically cautious notes, I think is fair to say, maybe thinking that the near term could be a little troubling, but, you know, they'd still be dip buyers if you do get, you know, a continued pullback. How do you see it as you have this stock?
Do you know that this stock is cheaper than Apple now on a PE basis? It's trading at 32 times forward. Apple's at 34 times. That's not cheap by any means. I was buying it when it was trading a lot lower than that, maybe mid-20s, when it was at a 13 EBITDA versus its average of 17. It's right back kind of like 15-ish, so it's not really compelling on a valuation basis, but that's not really why I own it. I mean, I own it because you can win in a lot of different ways, and maybe it pauses, Scott. That's okay. It's had a nice run this year. A lot of people own it. A lot of people own Mag 7. And as I talked about earlier, there's a lot of other themes and a lot of other places that you can put your money in other sectors, so maybe people are selling some of their winners and buying some of these other names. That's okay, but there's a lot of ways to win. They are a winner in retail. Whether the number in the last quarter came in slower than expected or not doesn't matter. It's still really good. 9% is really good. Companies would love to have that. So they have retail. They have retail margins that are expanding. We know AWS is expanding, and it's actually going to accelerate in the next 2 quarters. So that's really positive. And I don't think that advertising gets a lot of credit or appreciation. And so a lot of free cash flow here. They're spending a ton on AI. It's an AI play too. So I think if it pauses, that's okay. I'm going to hold it. But I love the fact that it's actually cheaper than Apple.
Well, Steve Leisman says it's going to be nice weather in the Northeast this weekend. If you're planning to go, you know, hunt for a house, be prepared for higher mortgage rates with the move today that we've seen post-jobs report. Diana Olick just has the newest numbers crossing. That's what you're going to tell us, right? The jump after this jobs report. Diana, to what degree?
You got it. That's right. The average rate on the 30-year fixed mortgage jumped 27 basis points this morning following the release of the jobs report. The rate is now 6.53%. According to Mortgage News Daily, that's 42 basis points higher than the day before the Fed cut rates by a half percentage point. Now, mortgage rates don't follow the Fed exactly. They loosely follow the yield on the 10-year Treasury. It's all about what the expectation is next for the Fed. Now, Matt Graham, COO of Mortgage News Daily, says the only salvation for rates here would be the notion that this is just one jobs report in a recent run that's been mostly weaker and that perhaps the next one won't be so damning for bonds, he said. But after the release of the report this morning, the Mortgage Bankers Association's chief economist, Mike Fratantoni, put out a note saying MBA's forecast is for longer-term rates, including mortgage rates, to remain within a relatively narrow range over the next year. But he said this news will push mortgage rates to the top of that range, but we do expect that mortgage rates will stay close to 6%, he said, over the next 12 months. Happy house hunting, Scott.
Yeah, no kidding, no kidding. Diana, thank you. That's Diana Olick with the latest numbers. I just want to comment on that as someone who's so bullish on the housing outlook.
I am absolutely bullish, and I will say, listen to Redfin, the CEO, and what happened when rates did come down from 8% last year to 6.1. You saw new home buying up 10% last year. But even he will admit, and I know this to be the fact too, you probably need to get rates closer to 5.5 to really see that pent-up demand be unlocked. But I still point out too that we are very short homes in this country, and the home builders have no intention of overproducing. In fact, they're underproducing. We talk about they're buying their own stock back relative to building more homes because it's cheaper at this point in time. The valuations are very attractive. Home builders have done very well in the past year. Look at the stocks, look at the charts. I think the home improvement companies are poised to do better and play catch up.
All right. We'll take a quick break. When we come back, the best performing stock in the S&P 500 is hitting fresh new record highs today. Rob Sechin owns it. We get the trade in 2 minutes. Let's do some stocks on the move today. Vistra is hitting another record high, up 75% in a month. You heard me right, 75% in just 1 month. 4 straight weeks of gains. Rob Sechin, it's your stock.
Yes, Scott, it's up 300%, if you can believe it, since we talked about it on the show a little over a year ago. And it's an example of what happens when you marry a quality business with great capital allocation, healthy profitability, and unique assets with a secular growth story. We continue to see increased demand for nuclear energy from the AI giants looking to feed the massive amounts of power they need for their AI models. That said, this stock is no longer cheap today at a 24 times forward PE, so we wouldn't be surprised to see it consolidate a little bit, but it's a very attractive secular growth opportunity for sure still.
You look, Steph, at GE Vernova very, very much the same way.
Yeah.
As Rob talks about this particular one not being cheap, yours gets downgraded today at HSBC in part because of what they consider to be the high valuation there.
It is a high valuation. It's up 96% since it was spun out from GE. And I've talked a lot about spin outs and how they work. And this one absolutely has worked. It's not cheap, but it is part of a secular theme. We're going to spend $4 trillion on the energy transformation between now and 2050. You want to have exposure to power, grid, data center, and it all is fueled by AI. So that is the whole theme. Yeah, maybe you don't chase it here, but into any weakness, you actually have to you have to own one of these. It's GE Vernova, Quanta Services, Eaton, or Vistra.
Let's talk about ExxonMobil, as there's been an awful lot of focus this week on oil and the energy market. New record high for Exxon today. They did pre-earnings 8K for the third quarter today. Jim, you own the stock. Give me it first. I know Steph does too, but I want to hear from you first.
So when you read the 8K last night, you'd say, okay, this is negative for the stock. Stock should go down. It's up today, as you pointed out, Scott, all-time high. Why is that? Because energy prices are high. And I think that when you look at the earnings stream, the earnings estimates for Exxon, you can see they've gone down massively over this year because energy prices have gone down. What if they go up? And, you know, I'm not saying definitely that energy prices are going up, but I will say that OPEC sees demand growing through 2050. That's at odds with the International Energy Agency. My point in this is that we're going to have this debate about wither energy prices, and there's a lot of room for them to go higher, and with it, Exxon's earnings.
Let's do Apollo, which is said to be nearing a deal to acquire aerospace parts maker Barnes Group for more than $45 a share. Jay's private equity. Hit Apollo for me.
Yeah, no, listen, I really like private equity, especially in this environment. It's up 19% in the last month, 9% in the last week. Fee-related earnings, steady to grow up to 20%, compounded into 2029. They'll probably have around $1.5 trillion in assets under management by that time. You see the acquisition of the Barnes, but they've been really busy in the industrial space. So there's other companies that they've acquired. So I just think activity, net realizations will continue to pick up as we work through this easing cycle.
Okay. Up next, Mike Santoli has his midday word. What does he make of the jobs report today and its influence on where stocks go from here? He'll tell us next. our senior markets commentators here at Post 9 with us. Talk about this jobs report today. I mean, yields obviously shooting up, maybe, puts a little bit of a cap on stuff, but I still go back to good economy.
Yeah.
Trumps smaller rate cuts anytime, right?
That's right. I mean, that's been, I think, what we've been suggesting, because you did get the last 2 months, you had that panic move lower, growth scare after you got some frustratingly weak jobs reports. So we unwound that. I mean, you mentioned the move in yields. It kind of went back to August 1st levels, more or less, in 2s and 10s. At this point, they kind of fell to their recent lows after those bad jobs reports, and then after these other kind of noisy numbers out there. So I think we're in a better spot. Slow Fed easing cycles are more bullish than fast ones. We've said that a while. The only way that that good economic news is not good news is if you really think it's a head fake. If you think it's a head fake and all of a sudden we're going to get less Fed and the yields are going to go up, but that's not what it appears, because you do have, the household survey, the establishment survey, the revisions, everything seems like it's in okay mode. You can't extrapolate 200,000 jobs from here, but the JP Morgan desk this morning assigned a 5% probability to over 200,000, which is insane, because these numbers are 50,000 wide of the mark all the time. The point is, that's your market response. I still think you're going to be a little restrained in terms of that real put the pedal to the metal risk response, just because of all the stuff we know we have ahead of us in terms of catalyst events.
I know you don't believe that small cap performance is a litmus test on the broadening of the market, because we've gotten the broadening of the market. But do you want to take a stab at the question that the Journal asks today? Why hasn't the Russell done better in this almost, we figure soft landing is going to happen environment?
I guess it's more just show me the actual results. Okay, I'm not going to just go by the historical playbook of, the Fed's cutting, that's got to mean small caps rip. I also go back to the idea, if you look at the major lows in relative performance of small caps, major lows, like generational lows from early 2000, the relative performance largely came from growth stocks crashing, right? So in other words, they held up better, they were a better absolute return, but it wasn't like they just went straight up, even though the relative charts make it look like it was an easy trade.
Good stuff. I'll see you on closing bell. We'll fill out the last hour of the week with Mike Santoli a little bit later. Coming up, we'll do our calls of the day. Do have a big upgrade for one of Steph's bank plays ahead of earnings. We'll do it next. Start with Morgan Stanley, Steph, which was upgraded today to buy from hold. HSBC is the firm doing it. They bumped the target up to 118 from 103. Quote, poised to outperform once again. That's what they say.
I hope so. It's underperformed Goldman Sachs and the markets since 2021, so it's been kind of a tough one in the financial services industry, but I do think you can win a couple of different ways. Investment banking fees, M&A pipeline really very strong. Wealth management should benefit from higher asset prices, and net interest income should help as the yield curve kind of steepens up. So stock's trading about 13 times forward estimates, gives you a 3.5% dividend yield. If Basel III, the endgame capital rules go into effect, as I believe they will, you're going to have a lot of excess capital that can be used for buybacks. I think this company will do just that. So I like it very much for the long term.
I mean, they will, but they won't be as onerous as, someone's thought, obviously.
19% to 9%.
That's right.
Yep.
And also your sort of general outlook on what you think the financials are going to do, because a week from today, we're going to be talking about their earnings.
I know. I think earnings are going to be okay, other than capital markets comps. FICC was up very strong in the third quarter of last year, but there's so many other moving parts at these companies, the big banks. They're so diversified, so I think there's a lot of ways to win. I personally like to own more of the pure play NII companies, like Truist Financial. That's 70% of their total revenues, and I've been adding to that.
Net interest income is 70%?
Yeah.
For Truist?
For Truist, yes.
Okay. Let's talk about United Health. Jason Snipe, it's yours. Removed from Morgan Stanley's all-cap growth model portfolio. They still like it. It's overweight. The target's 593, so we're basically there. That's why it's
100%.
That's why it's removed. Because we're basically there.
So I get that from that standpoint. UNH is a permanent compactor. All they do is just beat and raise very reliable earnings growth. Listen, the margins on Optum continue to expand. Utilization rates are upticking somewhat, so that's somewhat of a headwind. But I just think that this is a very solid company. They raised the divvy by 12%. So I continue to own this one and continue to like the upside going forward.
So Rob, you've been selling it down. Why?
We started last year, actually, in, I think, early 23. We've been patient with this stub. We're focused on other areas like pharma where we've been more rewarded, but our patience has paid off here. It's up 20% since Q2. I think the reason we sold it is because we saw some of the business trends begin to deteriorate. Loss ratios were a little off, and now they're beginning to stabilize. And I think we're going to maintain this stub and see what we ultimately do.
Steph, Home Depot's woken up. The target got raised to 450 from 390, reiterate by Guggenheim. It may break a 5-day win streak today with the modest decline that we're seeing here, but over a month, the stock's up 11%, which makes it a 17% winner year to date. Still an underperformer relative to the S&P, but not nearly as bad as it once was.
And it really didn't do anything for the last 2 years, Scott, because rates were so high and housing was really soft. And so that's why I think you could see a catch up to the home builder companies. But this company saw 7 straight quarters of negative same-store sales. They've never seen that before in the last 2 years. So I think you have very easy comps. In the meantime, profitability is very strong. You know what I feel about housing and home improvement companies. And so I still like it. It's not cheap, but this #1 player on sale, even with the move it has had this year.
All right, Chubb, downgraded to underperform. That's from neutral at Bank of America. We bring it up because we know of Berkshire Hathaway's position in the stock. Jim, you have one too. What do you think of this?
When we're talking about insurance, they've been great for quite some time. If we're talking about Berkshire in particular, look, this is important to Berkshire, but it's not the only thing. The thing that's really going to move Berkshire, in my opinion, is fixing the railroad. Burlington Northern Santa Fe has just underperformed its peers for quite some time. That's a fixable problem. But while that problem's being fixed, insurance should be great. We know premiums have been raised for the last 2 years, and they're making money from it.
Okay. We have a number of non-bank earnings next week. I know they're going to suck a lot of the oxygen out of the room, but we're going to give you the setup on the other names you need to know about next. To do the setup on some non-bank earnings next week. Delta, Tuesday, before the bell. It's up 12% in a month, on track, though, for the worst week in a couple of months. Jimmy, what's the outlook here?
Yeah, well, there's a lot of moving parts here. Obviously, when you've got missiles flying in the Middle East, that crimps air travel demand, at least in the international space. But demand overall for the quarter has stayed high. The problem with Delta shares the past several months has been overcapacity in the industry, and that has had an effect on pricing. Now, today, you've got some pretty dire news from Spirit Airlines. Look, Spirit Airlines loses money every time they fly. I mean, every quarter they've got negative cash flow. So hopefully, and I'm not saying this lightly, but hopefully Spirit Airlines is a source of capacity coming out of the market, which allows pricing to pick up. Demand stays strong. What we're looking for from Delta is indications that demand is staying strong.
BlackRock as well. Next Friday, before the bell. 52-week high today, trying for its 8th up week out of 9. It's up 20% in 3 months. Jason Snipe.
Yeah, listen, I mean, the stock has done very well. It's up 15% year to date. It's trading at 22 times forward. Listen, the inflows have been really solid in Q2. There was $51 billion in inflows. It's up to $10.6 trillion in assets under management. Again, it trades at a premium, but they have really solid margins, and I continue to like this one. I think it'll be a good quarter.
Fastenal is reporting next week, too. It's had a nice move, Rob, up 13% in 3 months. Looks like it's going to snap a 3-week winning streak now. You guys sold it over the summer, but I'm sure you have a take on it as we look ahead to the earnings.
Yeah, this is still a high-quality business, very economically sensitive, leveraged the industrial CapEx cycle. We sold it to buy more 3M. Our view was we were going to have maybe not the soft landing that everybody expected. For a period, there was at least risk to not having that soft landing. That has been taken off the table. But this company trades at a 32 times forward PE versus 17 times for 3M. And we just felt like that was a more diversified business. And we liked the turnaround expansion story and the focus on operational efficiency. Doesn't mean Fastenal is bad. They make a lot of stuff leveraged to the economy.
All right, good stuff. We'll take a quick break. We'll come back, and we'll do finals next. We're going to do final trades. Got the Dow good for about 180. We're in the green across the board after that way better than expected jobs report. Rob Sechin, what's your final trade for me?
Because of that report, I think people continue to buy Hokas and Tevas into the holiday season.
All right, up 5%. You mean the report on the possible sale of it?
No, jobs report.
Oh, I got you.
Just good
I got
for the
you.
consumer.
Oh, I got you. Okay. Citigroup up 1 3/4%. Is that Jimmy?
Yeah, and somewhat relatedly, when you think about the consumer having jobs, that means that hopefully credit delinquencies are not going to be the problem that we thought they were. That's going to be good for the credit card business at Citigroup.
All right. How about Ares? Whose is that?
Harris, that's me. I like the secular trend, how well they're positioned for private credit. So I like this private equity name.
Crowd 2.5%.
It's still down 26% from its highs, even though it just had a 33% snapback. I like it. Number one player in the industry.
All right. I'll see you at 3.